Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So, Peter, one of the key investment tenets that you believe in is that individuals should not be buying single stocks. Let's just jump right into that. Then we can talk about the broader market, but I'm curious about that.
Well, individuals should own stocks, but they should not pick stocks themselves. Because if you tell me that I'm going to be a stock picker and I'm going to listen to CNBC or Kramer and buy stocks, my question to you is this. You're probably going to spend, if you're really devoted to this, 30 or 40 minutes a day on your stock selections. So explain to me how you're going to do better than somebody who spends 8 to 10 hours a day doing the same thing, who's following the stocks a lot more closely than you, and who's probably analyzing them a lot deeper. So my conclusion is you're probably setting yourself up for failure if you pick your stocks yourselves. Let the professionals do it or buy an index fund.
Right, because you're not saying don't own equities. You're talking about owning equities through a basket of stocks, aren't you?
Exactly, and letting the professionals do the picking if you decide to go active.
Okay, well, let's talk about this specific market then. Obviously, people went into this with a lot of equities following the past several years of just it, and essentially uninterrupted bull market. Sure, there were a few declines along the way over the past 10 or 12 years or so, but it's been a roaring bull for a long time. People came into this holding a lot of stocks and maybe were not prepared for what's happening now. So how are you suggesting that investors handle the current situation?
Yeah. Now, first of all, let me make a broad comment picking up what you just said, Kate. Think about what happened when a couple of years ago when the pandemic first came about and all the jobs were being lost. GDP was going down. It was absolutely the most frightening economic scenario the United States could have imagined. And everybody figured we were going to have the worst crash ever. And what happened instead? We had one of the biggest bull markets ever. Go figure. Right. And take that into account the next time you try to predict the market, okay? But now valuations, especially in the tech area, got out of whack. And since the beginning of the year, we have had a massive correction. The question now is this. The decline in the stock market, if you had to pick one cause, it is inflation. And that is the thing that people are most worried about. And it's caused by a lot of different things, including the war in Ukraine, supply shortages, pent-up demand from the people who couldn't buy anything during the pandemic who are now out spending money like crazy. So inflation is the big worry. But in the last couple of weeks, we have noticed that commodity prices have come down significantly. Gasoline prices have ticked off their high. So there may be a ray of hope here, which is why the market has been so strong these past few days, I think.
Mm-hmm. Yeah, we are in a bit of a bounce back. And I think you're right. One thing I notice is that oftentimes the media will not report on exactly what you're saying, is that, for example, gas prices are down, that there may be some glimmers of hope out there, but I think cling to the negativity, don't they?
Yeah, no, absolutely right. And I have a particular advice for the Federal Reserve, somewhat presumptuous of me, but I do have advice. I've been doing this for over 50 years, so I figure I'm entitled to give them advice. And here's my advice. At your next meeting in a few weeks, announce that we're going to raise interest rates not by 75 basis points, the way you've been promising for the last month, but only by 50 basis points because inflation has come down a bit. If that happens, the consumer confidence will soar through the roof. the market will do a major happy dance and the Fed will have accomplished something positive with good reason.
Yeah, that is very interesting because you're right. It does seem like right now that 0.75 basis point increase is baked into everybody's minds anyway.
Got it. Right. But so imagine if they surprise, a positive surprise by saying, guess what? Prices have come down. It's working. We only need the 50 basis point increase. The positive sentiment that will engender is going to be massive, I think, if that happens. That's my advice anyway.
Yeah, that would be interesting if they heard this and followed you. That would be great. We'll send this out to Jerome Powell, see if we can get in his mind there. So, Peter, let me ask you this, because for years, of course, investment advisors have been telling clients you have to have equities to stay ahead of inflation. But I know that some of them are changing their messaging a little bit now. Not that that tenet doesn't hold, but because clients are more worried right now about inflation and what they're seeing their equities doing. So what do you say to that?
Okay. Again, depending on the age and the financial situation of the clients. Clients who are older, my age, or even a lot less, younger than me, need to worry primarily about preservation of capital because they cannot afford a 20 or 30% decline that sticks around, hopefully not this one. Younger investors should not worry at all because history shows, we can talk about this a little later, history shows that the market always comes back. We have 100 years of history that the market always comes back. So my advice to younger investors is to be invested primarily in equities. And unlike the advice we used to give to clients that, rebalance and look at your portfolio every month, my advice is get it right the first time, and I could tell you how, and don't look at it except maybe once a year out of curiosity, because it's going to grow until you reach that 55 or 60-year-old stage, by which time you'll have amassed quite a fortune, and then you can worry about preservation.
Okay, well, let's follow up on a couple of those points you just mentioned then. What is the best way to get it right the first time?
This is the subject of my new book. My prescription is this, after having studied this for over 50 years. Number one, you should invest in 2 index funds. The cap-weighted S&P index, which is weighted by size of the company, and the equal-weighted S&P index, which is where all 500 stocks have the same weighting. The reason for that is because with the tech boom, 6 or 7 companies in the cap-weighted, the normal S&P index, account for something like 25% of the index. So that is very vulnerable, and we've seen that in the recent market decline. So owning both cap-weighted and equal-weighted indexes is the way to go, and I also add a small amount of gold. But the main thing is, history shows, again, that it is very hard to beat the index, and 80% of active managers don't. So where do you want to put your bet?
You're talking about the S&P 500 and maybe a bit of gold. Where do you come down on the question of, say, international diversification?
Good. I'm glad you mentioned that because we did a study on that too. And I think there is only one international market over many, many decades that has outperformed the US. And I think it might have been Australia, which is a pretty small market. I have to double check that, but it's in my book. And there was no value long-term in investing international, number one. Now, by the way, companies are so diversified internationally now that you don't need to go to Europe to buy something with exposure to Europe. Most large American companies have a lot of exposure to Europe. Secondly, emerging markets, same thing. History shows that emerging markets over long periods of time don't help your portfolio. Over short periods of time, they might, but you're only going to own 5 or 6% of emerging markets in your portfolio anyway, so it's not going to help much.
It's interesting because one of the premises of, say, modern portfolio theory and other ways of investing calls for this broad international diversification. But one thing that I've always noticed, at least for the past decade or so, Peter, is that Europe, just to speak broadly of a developed region, has underperformed the US pretty consistently.
Yes, absolutely, Kate. Kate, you got it. Absolutely. And there's been no advantage. And again, I'm looking at long periods of time, decades, not short periods of time, which we can't predict. And modern portfolio theory doesn't work for investors who are growing their assets. It works for people who have a lot of money and want to preserve it. That's what diversification does. Diversification doesn't help you at all when you're young and trying to grow your assets, because we know the only thing that's going to make you a lot of money are equities. Bonds aren't going to make you money. So when you're young, you should be concentrating on only investing in equities and worry about diversification after you're rich, because it's not going to make you rich.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes.
Now, I want to come back to the question of the younger investors in just a second, but I want to talk to you about how you believe investors who are near or in retirement should be approaching the markets.
Okay, good point. Today, especially in this period of volatility and uncertainty, there are a number of investments with high yields and safe yields that provide income in the 6, 7, and 8% category that are really quite good. Now, in some cases, they're individual investments. In many cases, they're master limited partnerships. They are funds of preferred stocks. There are a number of these, and investors, by doing a little bit of research, can find some names that are very, very well researched with quite safe dividend incomes of 6, 7, 8%. Most people are very happy to get income of 6, 7, and 8% a year, and this they can do with much less volatility than the overall market.
So are you suggesting individual securities in that case, or once again, coming back to the idea of a fund?
They're both. In some cases, individual securities, but when I say individual securities, it might be a single REIT, for example.
Okay.
Warren Buffett owns one.
Oh, yeah. Okay, exactly. Well, I do think I've seen many portfolios, and I mentioned this in almost every episode, but I don't care because it's relevant in almost every episode that I said to you before we started recording. I was an investment advisor for many years, and sometimes the portfolios that people came in with, I mean, they would have just a ridiculous amount of stocks, funds, maybe an MLP. I mean, stuff they had no idea what it was, and there was no rhyme or reason to it. You're saying, let's get organized and have a strategy, right?
Exactly. And again, there's a little bit of timing effect here too, because this is a good time to be looking, for high yield. That is safe. And again, you have to emphasize that, the analysis has to show that the yield is pretty well protected, and it does.
Okay, that makes a lot of sense as well. Now, let's turn our attention to the younger investors that you were talking about and how they can get started and get their portfolio organized the right way.
Well, I've just written a book. This is, I think, my 8th book, investment book, 2 of which were pretty good bestsellers. This one is the culmination of 50 years experience in the market. Can I show you? This is the title, The Pure Equity Plus Plan. And it basically is a very simple plan based on 100 years of history that works. And it mirrors what we talked about just a few minutes ago. that you put your money systematically every month into 2 index funds, the cap-weighted S&P 500 and the equal-weighted S&P 500, with 10% in gold to act as a little buffer, and you put it away and you forget about it. The book is very short and it shows how to do this. You don't need any help in doing it, and you can set it up in minutes and just keep at it. I want to tell you, I conclude on the very last page in the book with, I transcribed an interview that Warren Buffett did with Becky Quick of CNBC. And he said, I bought my first stock when I was a teenager in 1942. He said, that's when I bought my first stock. And he said, since 1942, we didn't even know who was going to win World War II at that point. We didn't know about inflation in the 70s. We didn't know about 9/11. We didn't know about banking crisis. We didn't know any of that. But let me tell you this. If you had invested $10,000 in the market generally in 1942, how much do you think it would be worth today? And then Warren Buffett paused. He said, Becky, I want your listeners to think about this, and I'll give you the answer. And he paused for a couple of seconds, and he said, that $10,000, without you having done a single thing, would be worth $52 million today.
Okay. Well, that's something to think about. And of course, most people don't have that kind of time frame he did.
Of course not.
But the point is still,
maybe they'd settle, but Kate, maybe they'd settle for 10 or 15 million.
That's right. Exactly. Yeah. I mean, is the idea here, Peter, just kind of, is it set and forget?
Yes, it is what works. All you have to do is look at history and what has worked. The market is the single best source of wealth in the United States, and we have 100 years of history to prove it. And it always comes back and sets a new high. Now, you want to say history is going to change? Good for you. I'll rely on the 100 years that we've already got. And it is deceptively simple.
Yeah, it's interesting because I remember somebody I had a conversation with years ago who was panicked about one of these sort of, secular market downturns within the broader bull market that ended very quickly. It wasn't 2020, but it was maybe 2011 or late 2018. It was one of those. And I remember asking her to calm her down. I said, when has the market ever gone to zero? First of all, never, and not come back. And, she said, the Great Depression. And I said, no, neither of those things happened. People don't realize this. They have a negativity bias.
Exactly. So it's amazing how simple it can be. It's just that over the years, we've overcomplicated the process. And as I said, there is a very simple path for young people. It just takes a little bit of discipline and very little work to achieve a multi-million-dollar retirement income.
That's really encouraging, Peter. I really appreciate you offering that advice to the listeners. So we mentioned the book. Tell us how the listeners can find you and your book if they're interested in learning more about what you do.
Well, the easiest way in the world is to look it up on Amazon.com, and you'll find my book there, and you'll also find a whole bunch of other ones that I've written over the years, but stick with this one if you're young.
All right, and we will put that link in the show.
Thanks so much.
Yeah, thank you very much, Peter. I appreciate having you on the show today.
Then you do such a great job, Kate. It's been a real pleasure.
Thank you.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.